everyone, to episode 46 of Top of Mind with Consilio Wealth. Today is Friday, April 5th, 10:53 in the morning. Markets are open today. Jobs report was released. It was amazing, and the markets love it. It's just me today. Hal's on vacation, so it's just going to be me hanging out with you all for our time together. And we're going to talk through some market data of the last quarter. So first up, Q1 recap. The first quarter of the market was incredible. In fact, the market's been going kind of straight up since Halloween of last year. So basically 6 months kind of up. I wanted to digest that, or help you digest that a little bit, and talk through some stats. Jobs report, as I mentioned, crushed it. That came out today. Market's up. Maybe that's interesting. Maybe that's not. We can talk about that too. And as interest rates potentially or likely tick down at some point, maybe this year, the Fed is still signaling 3 times they're going to lower rates. Just do anything but stay in cash. We've talked about this a lot, and I had some new data that I wanted to share. Finally, Disney's proxy fight. Did anybody see this? This was in the news a lot. So Disney was involved in a potential board seat takeover. This is what's called a proxy fight. We'll unpack that, and I've got kind of an interesting story with that. I'm curious if any of you also had the same thing happen to you. Okay, well, with that introduction, let's get going. Q1 recap. So, gosh, the markets were really good. The S&P ended on Thursday, so Friday the markets were closed for Good Friday. So Thursday was the last day of the trading quarter. Markets were up 10% since the end of 2023, or I should say that the S&P was up 10%. That'll come into our discussion here in a minute because that's a key fact. This is the largest percentage increase that the index has achieved in the first quarter of any year since a 13% rally in 2019. This quarter was particularly good amid corporate earnings continuing to show positive growth. Also, economic data was mostly above forecasts. GDP numbers were good, jobs numbers were good, and interest rates actually bounced around a little bit, but ended up falling just a tiny bit. All of that was boosting expectations for the Federal Reserve's policy setting meeting, and they said that they're going to start cutting rates this year. Still, at the end of last week, a narrow majority of Fed officials reaffirmed projections for 3 rate cuts this year. So the Fed's been a broken record this year. They keep saying we're going to cut 3 times, we're going to cut 3 times. It sounds like that's all going to happen maybe in the back half of the year. GDP was revised late last week, right at the end of the quarter. So Q4 grew at 3.4% annualized rates. That is up from 3.2%. That's awesome. The University of Michigan came out with consumer sentiment update. It is at almost 80. That is very strong. Remember a number of episodes ago when we were talking about consumer sentiment being incredibly low? Our thought was it was related to gas prices, the food that you're buying at the store that just feels more expensive, and you're like, God, things just don't feel good. Well, since then, gas prices mainly had gone down, but they're back up. I just filled up at Costco the other day for almost $5. It's back up again. So I wonder if these consumer sentiment numbers are going to come back down because gas prices are so impactful to all of us as we just go swipe at the pump, or if potentially wages have increased enough to where people are worried less about their gas and food bills. I don't know. We'll see. We'll see in the future. Some interesting things here. So stat of the week or fact of the week. So the S&P ended this quarter, the Q1 of 2024, at an all-time high. It's 22nd all-time high of the year. That is on pace to break the 1995 record. Roughly 40% of the trading days in the first quarter were record closing highs, and that's the highest percentage since Q1 of 2013. This is the 14th best start to the year ever, and the 3rd best since 2000. Some other positive news here. When this has happened historically, the rest of the year returns have been positive from this point forward in 11 of 13 other instances. It's also worth noting that the VIX, which is a measurement for market volatility, has averaged 13.7 so far this year, which is on pace for the lowest volatility since 2017. Wow. can I get any more good news to throw at you? Geez, I don't know. Things look pretty good. Let's go a little deeper though. So let's unpack it by asset classes. So if you think about the S&P, which is commonly referred to as the market, I even do that too, although we know that there's a ton of other areas of the market to invest in and areas that we should be paying attention to. So the S&P was up 10.6% in Q1. That was the best performing asset class. If I dig into that a little bit further, can you guess what the best 1 or 2 or 3 asset classes were? Okay, well, with no guesses there, communication services was the best performing asset class this year. Now, that's a newer sector. The S&P had reclassified things into this sector a number of years ago, and so companies like Netflix are there now, for example. So it used to be AT&T and Verizon, which aren't maybe known for your huge growth companies, but your kind of stable companies that pay dividends. Netflix is now sitting in communication services, for example. That was the best performing asset class this year. What about number 2? Energy. Number 3, technology. Number 4, financials. Number 5, industrials. Then materials, then healthcare, then consumer staples, then consumer discretionary, then utilities. And the only asset class in the S&P that was negative so far this year, real estate. Real estate's highly rate sensitive. Now, I have to say, put a little disclaimer on this. Real estate that you see in your portfolio is not like your house. You cannot just go Zillow it or Redfin it. I think that all of us kind of look at our houses as stocks these days because they sort of trade almost in terms of we can get a mark-to-market value by just hopping on the internet. When you think about real estate in your portfolio, whether you own alternative asset classes like privately held real estate or if you own publicly held real estate, those are publicly traded companies that are generally quite highly dependent on interest rates or sensitive to interest rates, I should say. So if you think about like Prologis, which is a huge distribution center company, or Simon Malls, which is the company that owns Northgate Mall. They're redeveloping that obviously into the big hockey arena. I was just up there recently. It's super cool. Pretty awesome what they've done to that property. But of course, all of that stuff is done with debt. Real estate is almost always built with debt. Huge buildings are built with debt. Ultimately, then those buildings are leased up and then sold to pension funds and other investors and whatnot. So with just continued uncertainty and just relatively high interest rates, real estate has come down in terms of valuation. Again, I know that may or may not be the case for your home. I have heard that bidding wars are back in the greater Seattle area, specifically on the east side. So if you've bought a home recently on the east side, you might be in line with, 3 to 15 other people all warring over the price of the house once again. That's unfortunate to hear, especially at these high rates, but I guess housing is still highly in demand in our area. Okay, that's the U.S. markets. Really across the board was pretty good, at least the U.S. large cap markets. Developed markets had a pretty good year. Good quarter. Up about 5.8%. Small cap in the U.S. was up 5.2%. That's good. It's nice to see this rally broadening out. Oh, and I wanted to comment on that. So last year, what led the S&P up was kind of 7 companies, right? The Magnificent 7, maybe even 10 companies. Those top 10 companies were really what propelled the market up in 2023. It is worth noting that those same companies were mostly the companies that pulled the market down in 2022, right? Many of these big tech companies were down 30, 50, even 70%, but a lot of them came roaring back last year, and that's what pulled the market up. That is actually concerning, right? It's concerning when, 7 to 10 companies are swinging markets and 490 companies don't have any influence. Probably the best news that I would have for you here on this 10.6% Q1 return on the S&P is that the rally has relatively broadened out. So all sectors are participating in this. It's not just tech, which again, tech and then communication services are kind of overlapped. Yes, they were good performing sectors, but they weren't necessarily the top of the top. And that's a very good thing. All right. Commodities are up a little bit. Emerging markets are up a little bit, although emerging markets had some pretty good headwinds with the strength of the dollar. China's continued economic challenges and just general lackluster market performance. There was the surge in the dollar also took out some pretty good gains that Taiwan and Korea had. And Japan and the European stocks are touching record highs as well. A lot of that's driven by the yen's multi-decade lows, which makes their stocks makes the U.S. dollar equivalent of those stocks valued slightly higher. All right, that's a pretty good review of markets. I think that the first quarter, the best news, and what I want to reiterate there is that the rally has kind of broadened out. So it's not just 7 to 10 companies that are swinging markets. It would be great to see in future quarters if mid, small, and these other allocation or asset classes in the market can participate. Maybe that'll happen as rates start to fall. Rates have fallen a little bit, but as the Fed comes out and lowers rates, likely that bodes well for mid and small cap companies. And again, it would be nice to see this rally broaden out. Over long periods of time, you would expect mid-sized companies and small companies to outperform large just because of size, right? It's the small NVIDIAs becoming big or the small Amazons becoming big that fuels very, very high returns. And generally, you would expect that large companies would have less volatility. Still a good return, but it should be less than owning, say, a tiny company because of the risk that comes along with owning a tiny company. So we'll see. We'll report back in another quarter on this, but hopefully we've got just more good news. All right, on to our next topic here. So the jobs report crushed it. This came out today. So the U.S. added 303,000 jobs in March. That's a lot. It was only expected to add 215,000, and unemployment ticked down. So it's currently 3.8%, down from 3.9% last month. The central bank, as I've commented on, has continued to maintain their interest rate sort of rhetoric. They're holding for now. They're going to lower 3 times this year. That's what they say. Again, we'll see what actually happens there. And I do think that the market is definitely betting on that. A lot of this is priced in. We'll just have to see if the Fed does what they say they're going to do, and also how markets respond. Wage growth is still holding steady. That's actually, I think, good news. I know that's maybe a controversial thing to say, but really, wage growth has not experienced much movement in the prior decade. Only in the last now probably 18 months or so have we seen wage growth. That's good. Yes, it puts pressures on businesses. Yes, it can lead to less profits. That could then lead to lower stock prices. But I like to just think that if we can bet on some of the most powerful companies in the world, say these are giant U.S. companies, even small U.S. companies, to figure out a way to maintain profitability yet pay their people more, I think that's a pretty good bet to make, right? These are things like Chipotle rolling out the guacamole making machine so that they don't have to have a person do it anymore. Okay, could that lead to one fewer job or a few fewer jobs? Yeah, it could. But ultimately, if the jobs that are remaining are making more money, that's good. And the reality of it is that 70% of U.S. GDP is based on consumer spending, and consumers need to spend money. Consumers need to have money to spend money. So wage growth, I think, ultimately will go on in the future to be one of the best things that happened in this period for longer-term economic growth. Okay, so wages went up on a month-over-month by 0.3%, and that is at a 4.1% rate from a year ago. That's good. It's actually above inflation now. Inflation, at least in line with inflation. So that's, I think, again, good news. And the market loves it. Yeah, the market's up today. So this was a little bit like if the jobs report comes out really good, does that make the Fed pause on their rate reductions? That's what I would have thought. But the market's up today pretty nicely based on this news. By the way, no one could have been in a room. Can you even imagine what we've just experienced together? Like, we've experienced an incredibly steep rate hike cycle to where we all went from earning nothing on our cash, nothing being maybe 0.25% on a high yield savings account, to now you can get like 5% on cash. All of that happened in a span of 12 to 18 months. Wages went up, more jobs were added. There's a ton of layoffs happening, but still the economy is very strong in terms of jobs added. Wages have grown, and consumer spending has remained. Like, no one predicted that. Everyone thought that there was, 10 out of 10, 11 out of 10 economists thought that we were going to be in recession by now. It just seems so obvious. Maybe it's coming. It is coming. We know it's coming at some point. We just can't predict that accurately. Nobody can. I just think that we should take a step back and be a little bit blown away at what we've all lived through. I don't know if this is credit to Jay Powell to perfectly sticking the soft landing or the what were they calling it? The no landing. Like, you're coming down, they just go right back up in terms of economic growth. I don't know if we can credit him or the Fed's policies here. I don't know if we can credit revenge spending. I don't know if we can credit credit cards, which, yes, have ticked up, but aren't really at concerning levels. I don't know. But we've just experienced and are continuing to experience a pretty unique economic time where economic data is incredibly strong. People are employed. No other time in history have we had an incredibly high or incredibly increasing rate environment, but maintained near full employment, which is considered to be in that 3 to 4% range. That's incredible. All right, another tech talk. Maybe I'll give after that. Okay, so do anything but stay in cash. Cash has felt so good in the last number of probably about a year now, right? High yield savings accounts are in the 4s, even 4.5s. Money markets are paying in the 5s. You can get CDs that pay in the 5s, 5.5s. Do note that a lot of these CDs that are paying a big rate are only for, say, a year or 7 months. You can find CDs out there for longer terms, but they are almost always callable, which means, let's say that I buy a 5-year CD at 5.5%. It probably has a 1-year callable rate on it. That means at the end of 1 year, the bank can refund me or pay me out my CD money, and I don't get to keep the next 4 years of cash flows. It's basically every bank is betting on rates going down, but they also want to hold your money because when those rates go down, the money could leave, right? If you have incentive today to leave money in the bank because you're earning a few hundred or even a few $1,000s a month in interest, because depending on how much you have in the bank, you have less incentive to go spend. Interestingly, spending is kept up, but that's a whole nother story. You have maybe less incentive to invest, right? 5% with no risk feels pretty good. As interest rates come down and as those high yields become lower, you'll have more incentive to make a move. We would argue make that move before rates go down. But regardless of that point, banks sort of know that they're going to have sort of mini runs on this cash. So they're trying to lock it up by offering CD rates, 7, 10, 12, 2 years kind of a thing, in order to lock in that cash longer. It smooths their balance sheet. Again, look out for callable rates if you are buying CDs. Okay, so some data on please do anything but stay in cash. This is from Goldman Sachs. I just want to read this here. So as Fed cuts begin, investors should consider incrementally moving out of money market funds and into other longer dated debt instruments if you choose to stay in debt instruments. Investors awaiting the perfect signal to extend duration, such as the first rate cut cycle of the Fed, may be too late. And if you did wait until the first rate cut cycle to change around your money market fund, you've historically missed out on some returns. So I have a chart in front of me here that says, what if you just stayed in cash? And it's, of course, just a nice upsloping line that starts to kind of tilt off because it assumes that rates ultimately go up a little bit, go down a little bit. Versus if you made that decision to move into a longer dated, longer duration debt instrument, that could be even a 1 year CD, right? The duration of a money market fund is like 7 days. So those are often like swaps and things that are backing those. And so that's why that money market rate moves every day to every week. But a CD rate for, say, a year, of course, is locked for that year. So what this is suggesting is if you made the move to a longer dated debt instrument anywhere from 3, 6, 9, or 12 months before the first rate cut, you would have a substantially higher rate of return, upwards of 1% higher rate of return, versus if you chose to extend your duration 3 months after the first rate cut, 3 months, 6 months, 9 months, 12 months after the first rate cut, I should say. Sorry, let me back up here. If you chose to extend your duration 3 months after the first rate cut or 3 months before the first rate cut, then we are looking at forward-looking returns 3, 6, 9, and 12 months out. Okay, I hope that makes sense. So if you chose to extend your duration 3 months after the first rate cut, when we look forward 3, 6, 9, 12 months, the rate of return that you got is just only a tiny bit higher than if you just stayed in cash. Why? Because the assumption is that rates continue to go down on the cash yields. And so even if you extended 3 months late, you did lock in a tiny bit higher. If you instead extended duration 3 months before the first rate cut, your return is significantly higher. Can be as much as double. This is historical. Can be double, can be 1% more. It kind of depends on how fast they fall. But the point is, if you can lock in sooner, that is better. Now, conversation for another time on should you go and move from money market to a CD, or should you move from money market to investments? That is totally up to you and your personal financial plan. Everybody has different objectives for the money. I think the point that I'm trying to get across here is that if you were keeping money in the bank because 5% money markets felt good and you had no other reason for the cash, consider doing something else. But if you're leaving it in the bank and you are getting 5% on cash and you need the money in a relatively short period of time, say under 1 year or under 2 years, depending on what you're doing, maybe you're buying a house, doing a remodel, buying a car, whatever, possibly consider extending the duration of that investment to try to time with when you think you'll need the money, because you'll likely earn more money by doing so. Does that make sense? Hope that makes sense. I think I explained that 2 times. 1 time was backwards, 1 time was forwards. So I hope that makes sense. All right, shifting to our final story. Disney's proxies fight. Did you see this? Did you see this in the news? So this is a little crazy. So what happened? So this activist investor, Nelson Peltz, bought a bunch of shares of Disney. And what happens when you buy a bunch of shares or take a big equity ownership in a publicly traded company, or I guess any company, but let's just say publicly traded for this time. So if you take a big ownership stake in a company, you can get a board seat because you own a controlling interest in the company. Now, this becomes more difficult to do with huge companies like Disney, which is like a $200 billion company. But what Nelson Peltz did, and he's an activist investor, so he does this for a living, he bought a bunch of Disney shares and then he lobbied the board. He lobbied to get himself a board seat. How do you do this? Have you ever responded to one of those proxy votes that you get in your inbox? So when you own publicly traded stocks, you are a shareholder. Therefore, you have a right to vote for or not for the board. You can do this. You get these passed through to you in your inbox. I'm super curious if anybody has ever submitted one. If so, send me a message. I'd love to hear your story. Now, here's what's interesting, and I really want to know if anybody else got this too. Was I on YouTube? I think I was on YouTube. Yeah, it could have been Netflix. I was on YouTube the other day, and an ad popped up, and it was a Disney ad, and it was about the proxy vote, and it was something like, hey, we need your support. Please vote. It's very important to vote on the upcoming proxy vote. Anybody can vote and do it. And there was this little graphic, and it had all of the names of all the board members and a little animated graphic to approve, right? So the video was saying like, please just tell us that we can all keep our jobs. And I came away from that ad and I looked at my wife and I was like, did you see that? Like that was incredibly, persuasive is not the word. Misleading, like we need your support, and then like subliminally saying like just vote to keep all these people in here. That's what we want. Anyway, well, what happened was that is what happened. And 75% of Disney's, according to sources, 75% of shareholders voted in favor of the current board. By the way, I find that very hard to believe that that high of a percentage of shareholders actually vote in proxy votes. Maybe I'm wrong. So I want to know if you saw that ad too. Did you see that Disney ad that said, "We need your help in this proxy fight"? And, this little animation that said like, check, check, check on all the boxes. Let me know. I'm curious if you got that too. By the way, this has been done before. Most recently, you've all probably seen in the news that TikTok is it's getting pretty far along in, I want to say it's in the Senate now, and it might get banned in the US. Now, that does not mean that TikTok will go away in the US. What the stipulations are is that it just forces it to be sold or divested to a US company. So for all the young people out there listening, you won't lose your TikTok, I promise. For all the, say, parents that are listening, here's what I'm curious on. Actually, I'm curious across the board. Apparently, what TikTok did was they pushed a notification when you opened up the TikTok app to all the young people that are in their system that said, vote no. Vote no to forcing us to divest this to a U.S. company. They didn't they didn't push that same message to any of the above certain age people. I don't know what age that is, but let's just say the parents didn't get that message, and the kids did get that message. How interesting is that, right? Should that be legal? Interesting. So you have all of these users, and you're going to ask all of the ones that don't want to lose their TikTok, because that's what they think they're going to do. You're going to have all of them vote no. And then all the people that are possibly not as in love with TikTok, because maybe it takes a lot of their kids' screen time and it's kind of algorithmically addicting, those people might vote yes, so I just won't put the message in front of them. Interesting. Should that be right? Let me know if you saw the message. I'm not on TikTok, so I can't tell you if I got it. Let me know if you saw the message or if your kids saw the message. If you don't know, ask them if they're on TikTok. I'd be super curious if your kids got it and you didn't. And what do you think? Should companies be able to select who they send these types of messages out? I don't know. I'll leave my opinion for another time. Okay, so Disney's proxy fight. Disney won, which means that the current board is going to stay in place. I guess this wasn't too surprising, right? You've got this activist investor that comes in and basically was pointing to a bunch of things that Disney did in the past that he thought weren't great, but he didn't really have a great plan into how the company should improve in the future. Historically speaking, this happens a lot. Activist investors do this, right? They take a big position, they get a board seat, and then they ultimately try to wedge their agenda in. Sometimes that works out actually very well, so it's not always a bad thing. In this case, Disney prevailed, and Nelson Peltz will not get a board seat. It is worth noting that one of the things called out was that they need a replacement for their CEO, Bob Iger. Bob Iger, they've been trying to replace for 10 years. And he tried to retire. They brought a new guy in there. It didn't work. Bob came back. And so, I think it's a challenging position to replace. If you bring in an outsider, they might not know Disney culture. And I don't know if Wall Street's ready to have an insider take that CEO role. So Bob is currently just in that role. I think that was part of what maybe this activist was trying to push on was, hey, we need some new stuff at Disney. The other thing is the streaming business, which should be huge for Disney, continues to lose money. That just is what it is as they're building it out. Versus the other businesses, the old legacy cable businesses and whatnot, are declining in users just as people move from cable to streaming. But that business prints a lot of money for Disney. All right, that's it on Disney. I just thought that was an interesting thing to bring up. And again, ping me. I'd be super curious to hear if you got or if you saw that message, maybe it was like a YouTube ad for the Disney proxy, like, we need your support. And also, if you're on TikTok and your kids are on TikTok, I'd be super curious if you got that push notification when you opened up the app. This was a number of weeks ago, maybe even a month or two ago. All right, that's all the time we have today for our episode. I hope that today's episode was fun for you. It's just me. We'll get Hal back in the hot seat next time. He is enjoying a much-deserved vacation, and we'll catch up again in 2 weeks.